Welcome back. Just keeping an eye out on the SGX Nifty, which is still down by about 0.5%. And as we've been saying, most of Asia is also a little somber, trying to digest a lot of this hectic activity that we've seen overnight. Dipan Mehta, director at Elixir Equities, is with us to take us through the next leg of the show. Dipan, good morning. Thank you for joining in. Bit of deja vu, right? I have mini 2008 feels, with the operative word being mini. What sense have you made of all these developments, Dipan? And, how do you think someone should approach the market? Would you go in and acquire stocks for a portfolio, on every dip, or are you on the sidelines waiting for things to settle?
Good morning, Surbhi, and thank you for having me on your show. You took the words out of my mind. Deja vu is what I've been feeling the last entire few trading days.
Yeah.
That this is a rerun of 2008. But compared to 2008, so far it is a walk in the park. Let me tell you that. 2008, we were completely shaken and stirred. We had never seen anything like this before. But now I think at least we have a template, and more importantly, I think the regulators and the central banks also have a template how to deal with failures of small and large banks, even systematically important institutions. And I think they are following that playbook. So maybe this round of crisis will end soon. And I'm pretty optimistic that although these SGX Nifty is showing on the negative side, maybe you could have a nice pullback the next few trading sessions or so. But from an investment strategy perspective, we are in a wait and watch mode. We are seeing that a lot of stocks are coming into attractive valuations, good quality businesses, outstanding businesses, which were kind of out of whack when it came to price to earnings, price to book. Now, I think because of earnings have gone up, estimates have gone up, and stock prices have remained the same or corrected. I think they're coming in reasonable valuation zone. And soon, in about a month's time or so, we'll have our earnings season. So I think the best decisions on investment side will be made a month from now, when we have better clarity on the earnings, and I think the valuations also will be far more comfortable.
Okay. And what 2008 also taught us that the best time to buy stocks is during a crisis situation, right? That's the best time to build your portfolio. So I guess looking on the bright side, if this is another opportunity to do that, what would your shopping basket look like, Dipan?
I think in terms of sector identification, nothing really changes, because what we have seen globally doesn't impact Indian economy that much. And then, of course, software stocks may get hit a bit because of slowdown over there and some spending cuts on IT, but that already has got discounted. So you stick to the investment themes which are working and which are solid at this point of time, like the banks, capital goods, select consumption. I think all of those are pretty much doing fine in India, and we'll see that this earnings season will show these companies delivering on the kind of trend line and on the kind of growth that they have been sustaining over the past few quarters. And I think focus on those companies. You could add automobiles, real estate also to that list. I think travel, tourism, hospitality. I think the investment themes and the ideas are known in the market. It's just that the valuations were a bit on the higher side, but now with this correction and what further corrections may come, you may just have that these stocks coming into a bit of a margin of safety zone, which is very important from a long-term investor's perspective.
Dipan, so you're teasing us with the build-up. What are the names? Well, okay, let's just say, what are the top one or two names that you've got on your list and you're waiting for the right levels, or maybe you're already seeing the right levels as you go buying?
See, with usual disclosure that we and our clients are invested, I heard your story on HDFC Bank, and finally the approval has come through. So maybe buying HDFC to get into HDFC Bank, there's a slight arbitrage opportunity there. That may be a good long-term idea within the bank space. We also like IDFC First Bank, and Bajaj Finance also now has come into reasonable valuation zone. So a mix of two large organizations in the NBFC banking space and one mid-cap stock, IDFC First, comes to mind. Within the capital goods space, where we're extremely positive, companies like Larsen & Toubro come to mind. It's must-own stock in the portfolio. And then there are smaller companies like ITD Cementation. And then there is a very interesting company called Praj Industries, we've spoken about in the past, where the stock price has corrected significantly. And it's sitting on a very good order book position and has a fabulous growth opportunity because of the ethanol blending which is taking place within the country. Within the hospitality space, Indian Hotels, I think, needs to mention over here. Fantastic strategy, great focus on return on capital, and exceptionally good numbers. And then we're also looking at a string of these specialty retail companies like Metro Brands, Go Fashion, Active Sportswear. I think those are more on the market watch list just now.
Sure. you know, there's this big shake-up that's happening in the Indian IT sector, right? I mean, so many resignations in the top companies. Of course, Rajesh Gopinathan was the headline on TCS, but several others in the form of Infosys, etc. And then you have the exposure that IT companies have to some of the US banks. What do you do if you're an investor in these large cap IT stocks? Do you just keep the faith and hold on, or do you look to churn out?
See, I think what has happened in TCS, I think, is positive for TCS per se. Maybe having a CEO who's absolutely hands-on and who has driven the largest vertical within TCS, having him at the helm, I think, doesn't create any issues from a growth perspective. And maybe TCS, which has been lagging Infosys in terms of quarter-on-quarter, year-on-year growth rates, may see a mild reversal over there. So I'm not that perturbed about that particular development there. But within IT, you have to be in select stocks only, especially companies which are focusing on verticals where there is no threat to cut in spends. And 2-3 companies come to mind, KPIT, and we saw that deal they got with Honda. I think it's a very big, important development for that company. Tata Elixir comes to mind, Persistent Systems. I think these are the companies which are focusing on sectors where there is less effect of IT cut spending. And these companies have grown at far, far ahead of their peer group. So we are kind of concentrating on these 3-4 companies. Within the large cap, I think Infosys still has the most aggressive marketing strategy, because of which they have been getting very large deals and have been outperforming. So within the large cap, that remains our top pick. But it has to be an extremely selective strategy when it comes to software.
Okay, all right. Dipan, request you to stay with us for the time being. We'll just slip into a short break. On the other side, we'll get chatting with Mr. Mehta of JK Cement. We'll discuss inventory levels as raw material costs have cooled off.